Roger, you run an open-ended fund that invests in closed-ended funds, a real estate investment trust. That's what your fund invests in. Yes. So you're a great person to talk to about this. Could you just remind us and summarise what happened in 2016 after the Brexit vote?
So what has happened after the vote? Of course, you could see a lot of panic in the market, people selling, so the stocks coming down significantly. And yeah, you could see people withdrawing money. So what can we do? We can sell stocks in the market and raise the capital at the same day these events happen. On the other hand, the open-ended funds that are invested in non-listed property, they have a bigger issue because they do not have the daily liquidity. They can't sell a property the next day. So what has happened there?
So investors were trying to sell out of these funds,
yes,
and the managers of these funds couldn't sell their assets quick enough. They didn't have enough cash to give to the people who wanted to get out.
Yes.
And they had to sell properties, and that, we all know, takes weeks, months.
Weeks, months probably, yeah. and in a market where, you know, there's a lot of people trying to sell more assets.
Right, thanks Roger. So does you, Ben, I mean, what was the impact on investors? So the trouble is, when the news of these big property funds, open-ended property funds suspending gets out, it starts to undermine sentiment in the property market, people expecting these property funds to start selling. So what was the impact on your clients?
The impact was interesting, that actually the fund suspensions that we're coming on to talk about actually saved investors from panicking and selling, because they couldn't actually sell. So whereas they might have gone into the market and sold equities that day, don't forget, I mean, the stock market fell, I don't know, 500-600 points, didn't it, that day after the referendum. So people were panic selling everything. Mm-hmm. And the fact they couldn't actually sell property funds, or the open-ended property funds, because of the suspensions, actually saved them from making financial mistakes. They were tied in. The managers actually had time to kind of liquidate enough property sensibly. Mm-hmm. However, moving that to one side, they obviously couldn't do anything. You couldn't put new money in once those funds were closed, and you couldn't, in the open-ended funds, and you couldn't sell. So if you really wanted your capital out, you couldn't get it. But at least you were saved, in one sense, from making a short-term panic sell that probably would have cost you more money.
Calum, the Financial Conduct Authority has come out with proposals to stop this happening again. What's it suggesting?
Well, what the FCA is trying to do is just protect the investors, which is absolutely the right thing to do. So they're proposing a series of things they can do to try and prevent a run on units, to prevent this sell down in a period of volatility. So they're talking about suspensions when there's material uncertainty, I think in 20% of the scheme property. They're looking at dilution levies, dilution adjustments, and the fair value pricing adjustments that we've talked about. They're also looking at putting, I suppose, warning labels, is how you would describe them, on these vehicles to alert investors to the fact they're investing in a property which is illiquid. They're investing in something which can't be sold down readily in a time of market uncertainty.
Alan, let's turn to you. You've recently done some research comparing the returns of property investment companies, the closed-end versions, versus their sort of rivals, the open-ended rivals, which tend to be much bigger. I mean, most of the money is in the open-ended.
Although I welcome sort of the consultation by the FCA, I think they're missing the point here. The reality is, illiquid assets are not suited for the open-ended format. Your
research seemed to highlight that the managers of the open-ended funds, to deal with the risk that people might want to take their money out, the fact that they have to give people their money back, they were holding large amounts of cash.
Exactly. I think
and that erodes their returns.
Exactly. There's two sides to this. When the markets are sort of performing well, property is going up, we tend to see a lot of flows of retail money and institutional money into the asset class, into open-ended funds. The managers have to sort of go out and invest this in the underlying sort of properties. Again, we're back to illiquid asset classes. The flip side of that is when we have a more sort of risk-off market, what we tend to find is that obviously investors looking to take their money out, it means that managers are forced sellers. So they're having to invest in very buoyant markets when prices are moving against them, and exactly the same happens on the other side, in that they're basically forced sellers of assets in a market where there's not many bids.
The highlights coming out of your research in October were pretty striking.
Yeah, no.
Average direct property exposure in the investment companies is 131%. That's because of the borrowing, the gearing you were talking about earlier on. They can actually invest more.
Well, that's why they're not necessarily suitable for everybody, because of the gearing effect. And I think that's the risk bit that gets forgotten with investment companies, that actually in a downward market, that gearing is going to have a double negative effectively.
It helps it
helps
rise
it
far.
brilliantly, yeah.
In
So
rising markets, you go up more.
It's brilliant,
but
but
you
in
fall
falling
faster.
markets, it's a problem. I actually think the open-ended space can work for illiquid assets, but I think it needs to be more of a hybrid model, where actually, at the moment, the hybrid is cash plus property. That doesn't work because all the managers are, charging full fees on the cash and they're not doing anything for it, which actually is a disgrace, frankly, when they're holding 20-25% cash. But actually, a hybrid open-ended fund of direct property plus property shares is possibly the model to go down if you want to keep open-ended partially in direct property. At least you've got liquidity, you've got a bit of both then, and I think that's probably long-term the model that would work well, rather than 20% cash plus 80% property, which in my view doesn't actually work.
Roger, do you think that's, what do you think of that? You invest mainly in the equities, property equities.
Definitely 100% equities. I think just before I answer that question, I mean, as you can hear, I'm Dutch. So we used to have open-ended funds. Rodamco in the old days used to be open-ended. We closed them in the 80s after the crisis because of exactly that reason, that when a market is hot, a lot of money comes in, you're a forced buyer. When a market is weak, you're a forced seller. So we've dealt with that issue, I think, in the 80s.
So in the Netherlands, if an investment fund wants to invest in physical property, it has to be closed-ended.
Well, there are still a certain private funds which are kind of open-ended, but on the stock market, the Rodamco Europes and nowadays the Unibuys used to be open-ended, and we closed them in the big crisis in the 80s.
Yeah, I mean, closed-end funds, investment trusts aren't perfect. Their shares, as Ben was saying, their shares can fall when the gearing is working against them, but also the shares can fall to discounts and rise to premiums above. They're volatile. They don't necessarily. Whereas the open-ended funds, what you see kind of is what you get. The unit price is the price.
Yeah, exactly. The price that you have to sort of pay for the investment trust is you do get premium discount volatility. So if we went back sort of 4 or 5 years, a lot of the companies were trading on 15-20% premium. At the moment, they've sort of fallen to 10% as sort of we have a sort of Brexit sort of discount at the moment.
Yes, in your report you highlight one example of a trust, exactly as you say, trading at 20% premium above its underlying asset value, and then a year and a half later it's trading below that. If you'd bought in the top end and you sell out at the bottom end,
exactly,
you've lost a lot of money.
I think that's a risk. Coming back to Calum's point, this is a long-term asset class, but after the SCA report, we did actually have a look into the two sort of different types of funds, and we looked at the 9 sort of general UK funds, and we chose, so there's no cherry picking, and we chose the 8 largest open-ended funds. And first of all, we looked at the performance. The performance is quite stark, and it comes back to this point about the exposure levels. So at the moment, the average exposure level of the investment trust is 131%. The average unit trust is 78%. So you're getting a lot greater efficiency in terms of your exposure.
So on average, the average open-ended fund was sitting on 22% cash.
At this moment in time, it's cash or other liquid assets.
But if you look at the 5-year numbers, returns, the open-ended funds have done on average about 38% over 5 years, and the investment trusts have done about 46%. Now, in my mind, that's not enough differential for having a 50% difference in property exposure. So actually, something isn't quite, that property exposure isn't translating necessarily into the excess performance you'd expect.
You'd expect the property investment companies
to do better,
given that they've got so much more exposure to property.
Yeah, I think that's looking at shareholder total return, and that obviously includes the de-rating that you've spoke about. It's interesting over 5 years.
But that's what investors get, though.
Exactly, but it depends where you cut it. Over 10 years, which is an even better time period, the shareholder total return from investment trust is 11%. From unit trust, it's 4.3%. It's a massive difference. Yes. The total return there, what shareholders get, is 182%. If investors in the unit trust would have got 53, it's 3 times. It's a massive, massive difference.
What should the FCA be doing?
I think they need to promote the REIT structure or the
Real
closed-ended
Estate Investment Trust.
real estate investment trust, the closed-ended structure more. They've almost glossed over that as an option in that paper, which I think was a little bit dismissive. I think there's good reasons to hold the closed-ended companies in a portfolio.
What would you tell the FCA, the Financial Conduct Authority? What should it do?
I would start at the basis and do much more research on where the highest returns are, and that's coming back to that paper. And we've done a lot of research also in the US, globally. You see it coming back everywhere. Listed, liquid is generating a higher return, lower risk versus open-ended private. So I think that's the basic.
Okay, Roger, gentlemen, thanks very much for your views. I think it's pretty clear the FCA needs to do a little bit more work on this one, but thanks for your time.